Risk assets keep pushing higher, but labor and inflation data are causing uncertainty. Rumors are swirling about rolling recessions, and low summer volumes are giving investors anxiety. Will the Fed cut rates? Will it even matter if they do? Is higher inflation here to stay? And what do you do if you're an investor trying to navigate these markets? Hello, and welcome to Milk Road Macro, the podcast that takes CPI, PPI, PCM, ISM, and the rest of the alphabet soup of investing and translates it into English. I'm your host, John Gill, and today is Monday, August 18th, and we are joined by Craig Shapiro, Chief Macro Strategist at the Bear Traps Report. Craig is a macro portfolio manager with over 20 years of experience at firms such as Point72 Asset Management, Osprey Management, and his own fund, Circle Lane Capital. I'm very excited to have Craig give us some clarity on the macro landscape today, so if that sounds good to you, make sure you like and subscribe, share this episode with someone who would enjoy it. And as a reminder, if you are not subscribed to our Milk Road Macro newsletter, I highly recommend you do that. Macro is confusing. We're here to fix that. The Milk Road Macro newsletter is your shortcut to understanding how the big picture moves the markets. It's delivered straight to your inbox twice a week. Hit the link in the show notes to subscribe. And without further ado, welcome to Milk Road Macro. Craig Shapiro, how are you, sir?
John, how are you? Thanks for having me on this beautiful late August, I guess early afternoon. So thanks for having me.
Yeah, man, I'm glad to have you here. So look, I want to just jump right into this. There's a lot of people speculating about what the Fed is going to do at their September FOMC meeting. Just to lay out some context for everyone, a couple weeks ago, the market was not expecting a rate cut in September, less than 30% chance, according to most analysts. Then we got a negative revision to the jobs data. Suddenly, everyone was dead certain we were going to get rate cuts. And then last week, we saw a spike in the PPI data, which seems to confirm the fears that inflation might be coming back. Now it seems like a toss-up. The market is still leaning towards a rate cut, but it's far less certain now. Where are you on all this? Walk me through your thought process. What are you seeing? And do you think we're going to get a rate cut from the Fed at the September FOMC meeting?
Yeah, look, I think the payroll print that we got at the end of for July at the beginning of August, which led to the firing of the BLS chair and massively negative revisions to the prior months, really, I think solidified for many investors that the fears about tariffs and the fears about an economic slowdown were right, and so the economy is clearly slowing. It's probably slowing more slowly maybe than some people originally thought. But the labor market does seem to be showing some signs of deceleration. And that is what took the expectation for rate cuts for the September meeting to go from, like you said, about a coin toss to now I think we're pricing it close to an 85% chance. And in the early part of last week, we were pricing over 100% chance of a cut, which suggested that some people thought maybe we would cut 50 basis points for September. Look, the Fed is dealing with its dual mandate here, where it has a slowdown in the labor market, but still not a very loose labor market, right? Unemployment rate is still 4.2%. The expectations for the end of the year were 4.5%. So we're still a tighter employment market than most of the Fed were thinking. So we're dealing with some of that slowdown, which was expected, but we're also dealing with an inflation environment which remains challenging to understand for the Fed because of tariffs. Obviously, there were members of the Fed at the July meeting, Governors Bowman and Waller, who who dissented to the decision not to cut rates because they believe that inflation from tariffs is transitory and they want to get this cutting cycle going. And then there are obviously countless others who push back against that. And so what we saw last week with the CPI, PPI, and import prices is that inflation is not quietly going away. And not only is goods inflation showing some signs of reacceleration, which is expected with respect to the tariffs, but also services inflation is showing stickiness as producers are, trying to push along price increases to the consumer. So Fed's in a tough spot here. Probably should be cutting rates to address some of the slowdown in the labor market, but it has a dual mandate. And if we're not rapidly getting back to 2% inflation, then it needs to be cognizant of that. So at the June meeting, when the last dot plot came out, half the Fed had been looking probably for no rate cut for September. And so as we approach the September meeting in 4 weeks, there's still countless members there who are not going to be looking to cut rates unless the data between now and then massively decelerates. And so I think there is some uncertainty heading into Powell's big speech later this week.
Yeah. So I think that that kind of aligns with what I've been seeing as well. I do think that whatever decision that they make in September, it will be a split decision no matter what they do, which is kind of a signal in and of itself. You mentioned Powell. There's a speech he's scheduled to give at Jackson Hole on Friday at their annual symposium. What are you expecting to hear from him? Do you think he's going to tell the market one way or the other if they're leaning more towards a cut or towards holding, or do you think he's going to try to stay non-committal? Like, what are you expecting to hear from Jerome on Friday?
Yeah. I mean, I guess there's three ways to think about it. One, he does what he did last year, where he really used the Jackson Hole speech to set up the cuts that came in September, and he was very adamant that the labor market had deteriorated enough and that inflation seemed like it was coming back down. And so, even though the Fed had not cut in July, he used Jackson Hole to really tee up the cutting expectation for September and actually move the odds very aggressively, where folks were pricing in an increase in chance of 50 basis points, which is what the Fed wound up delivering. I view that, in light of the inflation environment, as a pretty low probability outcome. I don't think he personally is there yet, and I also don't think he wants to seem overly political. Obviously, there's a big political case here from the administration pushing aggressively against the Fed to start rate cuts and aggressively cut rates. So I don't see him doing that, but there is, I'd say a 5 to 10% chance that he does that. I'd say there's also probably a similar chance that he completely shuts the door on the September rate cut. And he basically says, look, this is what we expected. This is why half the Fed in the June dot plot was relatively hawkish. And I myself, the chair, see this acceleration of inflation, which we expected from tariffs, has come back. And it makes it very challenging for us to believe that we could cut rates and still achieve our 2% inflation target by, let's say, the end of next year. So I'm going to use this speech as a way to remind the markets that the Fed is hyper independent. We don't listen to the administration at all. And when the data says what the data says, there is really no indication that we really should be cutting rates unless we get another massive deceleration in the labor market and negative revisions. So I also view that as probably a 5 to 10% chance. There is a chance, look, he wants to really kind of come out. This is his last Jackson Hole speech as chair and solidify Fed independence. So I think there's probably a little bit more of a bias maybe than that first dovish case, that he will come out, a little bit more hawkish and try to take the rate cut odds down from 85% or so today to more like 50-50. Then I think there's a more likely case where he just kind of, gives status quo. If the data continues to show deceleration in the labor market and we can show some further momentum on the inflation side, most of the Fed is looking to cut rates in September, and he probably stay in that 75-85% chance of a cut, through the end of next week and until we get the first the week of September when we get the August labor data. So, I think most market participants are probably looking for that status quo outcome, and he hasn't really moved the needle too much. But it is an important speech here because we know that their governors Waller and Bowman have already dissented. We know that there are some other members that have been pushing more towards the dovish camp, but it is important to hear from the chair. And given it's his last one, and given how how horrible the administration has been towards him personally with the insults and everything, you can imagine him kind of trying to deliver a little bit of a mic drop here about Fed independence and saying, look, it's just too soon. We need more data. And September data is really not going to be enough. And he tries to push out, this rate cutting expectation towards further out in the fall.
Yeah, I think that kind of makes a lot of sense. I agree with you on that analysis there. I don't necessarily think he's going to come out and throw up his hands and be like, okay, I'm cutting, you win. But I would like to see an episode of Jerome Powell Strikes Back where he just, kind of lays the hammer down and says the Fed does what it does. So we'll see. I think I'm with you, though. I am kind of in the middle of the road there. I think he's going to try to say, hey, we're very data driven, but not really kind of signal to the markets one way or the other. You've been writing a lot on your Substack about the Fed's quiet surrender to inflation. And you're basically saying that they've given up on seriously trying to fight this and are sort of acting like they are, but have kind of accepted that we're in a higher inflation environment kind of permanently. Do you think that this is due to them just facing the realities of the market? Or is it more about, like you said, this mounting political pressure affecting the Fed's independence and their ability to set monetary policy without the consideration of fiscal dominance. Like, what's driving that? Is it just the way things are now, or is it like them caving to political pressure?
Yeah, I guess it's, probably a little bit of all that, stuff. I mean, it does seem like they are more receptive or more concerned when the labor market shows further signs of deterioration than they are about, any particular pickup in inflation, or certainly kind of really getting inflation back down to 2%. I mean, there's been countless episodes over the course of the last couple of years where, let's say, the labor market showed a little bit of slowdown, and then the Fed came in and kind of either they cut QT, or they did something else to try to introduce the likelihood of rate cuts, which happened in the, let's say, the fall of last year, even though inflation hasn't really shown that it's going to get back to 2% in any reasonable period of time. So they to me, they're showing that. And even Powell at the last press conference, when asked about the tariffs being transitory, he said, "Yeah, we have been actually looking through the tariffs because under normal circumstances we would have been hiking rates in light of all the tariffs and inflationary pressure that we've been seeing over the course of the last year plus." So clearly there's this bias that I keep seeing, and I think the markets have sniffed that out, right? I mean, you see the gold market at all-time highs, you see crypto and Bitcoin markets basically, or at least Bitcoin back at all-time highs, and certainly more capital moving into crypto as the markets are becoming more sensitive to this idea that the Fed will sacrifice its 2% inflation mandate if and when either the labor market slows down, or if risk asset prices come under a little bit of duress, or if the bond market shows any real signs of selling off. And so I think that combination of labor plus fiscal dominance plus is it really worth is it really worth putting the markets or putting the economy into a recession just to achieve that last 50 basis points of inflation falling from 2.5 to 2? I feel like that is something that they've resigned themselves to this idea, and I think that the risk asset markets are showing as such.
Yeah, I agree with that a lot. I think the Fed has sort of decided, hey, the juice is not worth the squeeze on getting this last little bit of inflation out of the data. I want to pivot now to something you touched on a little bit there, but this idea of a K-shaped economy. And you spoke about how a lot of risk assets, Bitcoin, and so like the Mag 7 stocks have sort of like really accelerated into inflated valuations, but the broader economy and like the rest of the S&P 500 has not really participated in that. So I want you to like flesh out this idea of what is a K-shaped economy and why does this matter so much right now? Tell us about what that looks like and what you're seeing.
Yeah, I think people kind of see this bifurcated market where large cap is really outperforming small cap, and companies with access to cash and access to borrowings are doing incredibly well, and companies that are, have less access to capital are struggling much more mightily. And then you can kind of translate that into the economy at large, right? Where wealthy folks and homeowners and asset holders have been doing incredibly well, but more and more low income workers, middle class, working class are struggling to stay afloat amidst a highly inflationary environment and an affordability crisis, right? And even though the rate of price change, which is inflation, has been showing signs of deceleration, there's really not been enough of a catch up in real wage gains to pay for the cost of living and rents and insurance and utilities and really the necessities of the working class are continuing to move higher and are not showing any signs of falling or any signs really of materially slowing down. And so you have more and more folks that are falling into this lower part of the K-shaped economy, and so that's why you have kind of these weird dichotomies where the asset markets are at the highs and the sentiment surveys for consumer expectations are at the lows, right? And you have, a general angst in society that has been developing and growing as people are more concerned about their labor outlook, particularly in an environment where AI continues to accelerate. So I think you have this weird market, right, where those that are doing well continue to do incredibly well, and those that are doing poorly are continuing to do even worse. And so what I think the administration is trying to say is the Fed should cut rates, right? Because at least if the Fed is cutting rates aggressively, Trump wants 300-400 basis points of rate cuts, but even Bessent says we should be operating back down at neutral rates, which are 150 basis points lower than today. That will alleviate some of the pressure on consumers. Borrowing costs will go down, mortgage rates are likely to go down, auto rates are going to go down, credit card rates are going to go down. And so that will alleviate some of this pain on the low consumer. The question is that really going to happen? If the Fed is cutting rates into an inflationary environment that's already showing signs of getting of continuing, what's going to happen to the bond market? Is the long end going to sell off again like it did a year ago when the Fed cut rates? If the Fed is showing that it's really not willing to bring inflation back down to 2%, and so I think that it would, and so even though the administration is targeting bringing down rates, and we know also they want to bring down rates to help lower borrowing costs for the federal government, but more and more people are going to continue to find themselves struggling if the long end sells off, right? Mortgage rates don't really fall. Auto rates don't fall. Credit card rates now are mid 20% level. In 2008, they were in the mid teens percent level. So there's a lot more that needs to happen here to help this affordability crisis out. And it's not clear that the Fed or the administration really are doing anything. Well, certainly not the Fed, but even the administration is not really doing much to address that. And so I think that continues, gets worse. You're seeing it in some of the polling data now for Trump, where his cohort of supporters under the age of 35, that support is really starting to show signs. There was a Pew poll out last week where those approval ratings have gone from mid 90% to 60-65% now for those under 35. So he's starting to lose some of the support from some of the base of voters that helped him get elected, because there's an affordability issue for a lot of young Americans. And so, I think that's why we have this bizarre dynamic here where stocks are doing incredibly well, and Trump touts a record stock market every day, but more and more Americans really aren't keeping pace with that development.
Gotcha. Yeah, I think that this is something that a lot of people have been observing and experiencing from a lot of different directions. I think general angst is what you described it as, and that kind of tracks. I think something I've seen from the Trump administration is they're trying to bring back a lot of manufacturing, a lot of jobs, a lot of production into the United States with their tariff policy, but also with a lot of the AI infrastructure that they're trying to invest in. Do you think that these policies, this general kind of pivot towards trying to bring a lot of this economic activity onshore, do you think this is going to be effective? Because this is, I think, one of the things you haven't mentioned that they are trying to do. And how long do you think it will take to be effective? Because it's not something you can't just rebuild a manufacturing industry overnight. Yeah. So what are your thoughts on that in terms of effectiveness and the time horizon there?
Yeah, look, I mean, I think the administration and Trump and the Republicans winning the Senate and the House, they came in on a mandate to lower inflation via ending profligate government spending, returning manufacturing jobs to America via, assisted by the tariffs. And so, and also closing the border and reducing immigration, which was going to, have the dual impact of, increasing safety in their mind, but also increasing real wages. And so those were the reasons that I think the administration kind of got into power. And I thought that was a cohesive, interesting framework, which I thought, would take time, and we'd have to go through a detox period and a position of in a slowdown. And Besson had talked about this public to private transition, which we were going to go through. It's going to take a few quarters, but trust us, it's going to all work out. And the markets, kind of ahead of the inauguration, were excited about it. And then when Trump got a little bit more aggressive on the expectations for tariffs, market got incredibly spooked. And what did he do? He basically kind of abandoned a lot of the aggressiveness of that agenda, right? We saw from the Doge cuts, Elon basically threw up his hands and said, you know what, I really can't cut spending here. And so the one big beautiful bill wound up being a deficit buster as opposed to a deficit reducer. And then with respect to the tariffs, Trump went very aggressive, but once the market started to show consternation with that, he really backed off, and the taco monitor was born. And so, look, I think the idea of bringing manufacturing jobs back and cutting spending, I think, was the right plan. It was going to take multi quarters, if not years, but the administration got incredibly impatient. And the reason I think they got impatient is because their donors and the donor class and the wealthy and technologists and, really started to say, hey, man, we can't really do this. And so he kind of is starting to cave on a good part of that part of the agenda. And so what we're seeing now is just run it hot. He's supporting big caps over small caps. He's having CEOs come into the, big cap CEOs come into the White House. Well, how can we work together to keep enriching these big companies and going? And so he's look, I think the manufacturing job plan was a good one. I think the AI CapEx idea was a good one. But I think now it's kind of gotten to the point where it's happening at the expense of bringing inflation down, right? The AI CapEx boom, that's going to lead to higher utility costs, higher water costs, higher land costs. It doesn't help out that base of the administration that or of the support that voted him in. And increasingly as we build out more AI, job displacement is going to be an issue for large swaths of white collar America. So I think there was a chance there to kind of bring it all together, but now I'm more concerned that some of the how do I put this gently, the grift and the favoring of entrenched interests and lining his own pockets, I think has led to kind of a more jaded view, and so more people are getting annoyed by the strategy or not seeing it work for them. And so I'm concerned that we kind of have the worst of both worlds here. So we have continued exacerbation of wealth inequality, a continued focus on the rich getting richer and the working class struggling more. And for markets, I think that's why we continue to have this bifurcation. How long can it go on for? Hard to say, but we're tipping the scales here a little bit. We're getting very stretched in some of these relationships, and if we start to see some more hiccups on the AI profitability story or a further slowdown in the labor market, I think asset prices could be due here for a more sizable correction as people try to take a little bit off the table here after what's been a pretty phenomenal run since the Liberation Day lows in early April.
Sure. Yeah. And I've heard a lot of analysts kind of forecasting like, hey, the market looks like it's kind of primed for a correction here. Yeah, I appreciate the insight and analysis on that. I think, as we have continued to see sort of like what's played out with some of these social and economic, like, political issues that you've described, it's really easy, I think, for macro analysts to paint the bearish picture, right? And I think I've heard that from a lot of people. I'd be curious to hear from your perspective, though. We've had, I think, 5 companies in the last, it was a week or two ago, 5 companies from the S&P 500 posted earnings, NVIDIA, Google, and so forth. They beat earnings estimates by a combined total of over $18 billion. And so what I'm seeing is, there is a K shape, right? It's easy to spell out the problems of the lower half. What opportunities do you see for the top half? In other words, like, what opportunities are in this environment for investors to take advantage of, and where are the opportunities to like benefit from this circumstances we're in, as opposed to just focusing on all the bearish things and the issues and problems we've described?
Yeah, look, I mean, I think you have to really, I think, continue to kind of stick with what's working. I think there are people who are trying to maybe make the case that this rally should broaden out, and that there's other companies that are going to now take the mantle, let's say, from AI and kind of AI led names and move higher. But in my view, the AI capex story is still locked in, for at least the next few quarters here. So it's not clear that we're going to see a material deceleration in the capex spend. We may start to see, some companies in the value chain fall away or profitability isn't there, but I don't favor moving away from what's been working. I think you can kind of stick with what's been working, be opportunistic, add on weakness, but I don't think we're going to see a broadening out, because I think that this K will continue to widen. Haves keep winning, have-nots keep losing. And even with the beginning of a rate cutting cycle that's likely to commence in September, a 25 basis point rate cut is really not going to do much for lowering inflation or lowering borrowing costs, or making the working class all that much better. So I think you really you stick with what's working. And with respect to, let's say, this inflation idea, I think on any chance that we get where markets correct and the administration starts to become a bit more concerned that it's going to lead to a larger slowdown, they're going to do something to prevent it from happening. They're going to come in and sell volatility. They're going to think about ways to print more money, for lack of a better word, whether it's through treasury issuance, reducing the amount of coupons, whether it's doing more whatever the case may be. So I think the idea of sticking with gold and sticking with Bitcoin and buying kind of stores of value on this debasement trade, because the inflation's unlikely to really ever get down to 2%, I think that makes sense as well. So it's a little bit more of sticking with what's working, as opposed to trying to believe that this is going to be some broadened out, everyone's just all time, the rising tide lifts all boats type trade. Now there are plays in the AI infrastructure with respect to power and the picks and shovels part of the AI build ups I think are interesting, but I don't really see a case to be made for discretionary spending and housing and small caps. I don't think you benefit from rotating portfolios towards that. I think you're more likely to benefit by sticking with what's been working.
Gotcha. I think that that's something that's been borne out so far, right? Like the momentum trades have continued to gather more momentum. Gold, Bitcoin, the Mag 7, a lot of these risk assets have done well, and I would expect that to continue. I want to kind of go back to something we've been talking about a little bit here, is but like how politics kind of plays into this. And historically, there's sort of been this idea of the Fed put, where like, if the market starts to puke, the Fed will step in to sort of steady the bond market, steady risk assets, and kind of like keep people from panicking. It seems to me now in this paradigm, the Trump administration views the continuing success of the United States in the AI race as a matter of national security, which, I think this is a bit of a dangerous idea as an investor, but it seems to me like they're willing to go out and sort of support at risk assets if the stock market starts to puke now, because they view this continued support by the market of this investment that they're making as strategically important to national security. One thing that comes to mind, like Scott Bessent offhandedly on Fox News said, like, we're not buying Bitcoin, and then like later that afternoon tweeted out like, we intend to have a strategic reserve, we're gonna, like, because he wanted to steady the markets because he kind of spooked the crypto markets. How real is this in terms of like a thing that investors should pay attention to? Like, do you think that the Trump administration will continue to step in to try to keep the market bullish, or do you think that eventually at some point they're going to have to kind of like keep their mouth shut and let whatever happens happen?
Yeah, look, I mean, like I was mentioning earlier, when they came into power, there was a lot of talk about a detox period, a transition period. I don't care about the stock market. Just give us some time here. We're dealing with the disaster of the prior administration that left us with 37 trillion in debt and $2 trillion a year deficits. So and this is going to be a bit of a transition. Trust us, we have the right team in place. Things are going to be better by the end of 2025, and the run up to 2026 is going to be terrific, right? And so the markets kind of tested that narrative in March and April, and what happened? The administration flinched, right? I mean, and so we saw a big coming back on with respect to the aggressiveness with which the administration talked about this detox period, such that now, prior Bessent had been saying, look, Wall Street, had done great forever. It's now Main Street's turn. Now what he's saying is Wall Street continues to do great. Main Street's going to catch up, right? You can already see that the narrative has been shifting. So yeah, I think that this administration is going to continue to try to do things to support asset prices, keep the markets afloat whenever it can. The biggest, but I do think the biggest market that they are concerned about is the bond market, is the long end of the Treasury market, which is why they, been really trying to force the Fed to cutting rates, because they think that bringing down the front end is going to bring down a wholesale shift lower in interest rates throughout the curve. And as long as you believe in the AI story, productivity gains are on the come. We're not going to have inflation, and so the long end of the bond market is going to continue to rally, because people will believe that there's no inflation. That's the administration's view. So I think they're going to continue to suppress volatility whenever it gets elevated. The question is, when it's as compressed as it is right now, I mean, the MOVE index, which is the U.S. Treasury volatility index, is basically 3-year lows. Bitcoin volatility has been making new lows recently. S&P volatility, right? So we've taken volatility down to an extraordinarily low level. The risk to pushing that further lower is a rise in inflation expectations, right? If we keep pushing and pushing, inflation is going to come back. Wealth effect gains will continue. Spending will go up, and then inflation will never be slayed. And so I think the administration is kind of dealing with that pendulum. They don't want to see inflation reaccelerate, because inflation is the Achilles heel for the administration. If we're talking about inflation in the third quarter of 2026, Republicans are going to get steamrolled in the midterms. I think the administration is very cognizant of that. And so is there a chance here now, when volatility is super compressed, that they let a little bit of air out of the balloon, right? They allow the volatility to come back. Seasonally, you'd expect it in the August, September, October period. How many years in a row or over the last 15 years have we seen markets correct somewhat in this period of time? So I think that maybe the administration will use that, Bessent maybe will use that to his advantage and say, look, this is a good chance for us to, let some of the froth out. We get a little bit of a correction. No one really gets laid off, though, because companies aren't really, they still see the benefit to the administration's tax policy and 100% depreciation on capex, and the outlook for 26 looks pretty good. So, but let a little froth out here so we don't have an inflation dynamic that prevents the Fed, let's say, from really cutting rates. I think that would be a prudent thing to do. I think Bessen's probably in favor of something like that. The question is the big guy really going to be in favor of that? Is Trump going to allow some that? Can he be convinced that that makes a lot of sense? Very difficult to say. But we'll see what happens here over the course of the next few weeks. A lot of data coming up that needs to be digested, and also this Russia-Ukraine dynamic. Maybe he uses that in some capacity, but we'll see.
Okay, so I appreciate the insight on this. I think that there's the takeaways for me here are that there's a lot at play right now. There's a lot at stake, and there's low volatility because it's the summer. The Fed's trying not to spook the market. The Trump administration's trying not to spook the market. It's a great time for investors to be leaning in and paying attention because we haven't really gotten a clear signal one way or the other. And when that comes, I think the market will move pretty rapidly. So I'm kind of like, just like everybody else, like paying attention to see what does happen here. But I agree with you. I think we'll probably see a continuation of what's working to continue to work until further notice. I want to pivot now to ask you some questions about your Substack. It's called the Bear Traps Report. I think that's a really interesting title, especially at this time, right? Because I think so many people, especially in the macro analytics space, have gotten quite bearish or like convinced themselves that there's a big crash coming. And I think that that's a trap that a lot of investors can step in. Explain to our audience, what is a bear trap and what are some of the biggest bear traps that you see posing risks to investors right now in this market?
Yeah. So the Bear Traps Report was founded by my partner Larry McDonald. Has been doing this for forever. What we do is we write a weekly report, we write daily reports, and then we have a very active institutional chat with hundreds of clients throughout the world, buy side clients, and so we try to ascertain, what's the narrative on the street, what are people talking about, what's important, what's moving, what's rotating. It's a great insight onto what Wall Street is thinking, and we provide research and we kind of aggregate a lot of that data and provide it to each other, to other clients on an anonymous basis, so people really have a sense for why people are doing things and what's moving. And so, but with respect to what a bear trap is specifically, it's when it's more like a technical term, like when people get very concerned about something, and then all of a sudden the rug gets pulled under that negative view, and markets recommence their moves higher. And so really what I think people are forgetting, and sometimes I even have a tendency, to forget this too, is that even though the bear case often sounds more intellectually correct and interesting, the administration, or there are certain interests, whether they're governments, whether they're Federal Reserve, central banks, whether it's in oil markets like OPEC, or there's certain economic actors that will prevent adverse outcomes from happening, and they have the power to arrest market declines or asset price declines, right? I mean, you can see it, more recently last week with this United Healthcare. What's a bear trap there? Warren Buffett coming in and buying some, right? It's like, there was a well-articulated bear thesis on United Healthcare. It's been getting, crushed for months. So all of a sudden you have the stickiest capital in the world comes in and says, we're good here. We're going to take an interest, right? And so, but even more broadly, I think it's a reminder that when volatility in asset markets, particularly in the treasury market, fixed income markets, the equity markets get very elevated, the administration or the central bank will work actively to push that back lower. Vol suppression is part really of their mandate and their MO. And so you cannot get overly enamored by an intellectually stimulating bear thesis, because you don't exactly know what the pinch point is for the government or the central bank to come in and intervene in some way to keep that going. And so we saw that in April with the taco move, right? I mean, it was clear the Trump administration thought it was getting somewhere, was pushing with China as they were ratcheting up, we were ratcheting up, and then all of a sudden 145% tariffs on both sides. Supply chain is coming to a virtual halt, and rare earth shipments from China to America basically dry to zero. All of a sudden, somebody reminds the administration, hey, without rare earths, like our economy can't work, our military can't work. And all of a sudden, boom, a couple of days later, reciprocal tariffs are taken back down to 10%. The trade war is effectively stopped. And risk asset markets have a violent correction back to the upside. So it's a reminder that you can't get too complacent with a negative view. Economic actors will come in and step in, and so as long as that happens, you have to be mindful when you're negative. And so that's kind of how the bear trap works. And you don't want to find yourselves into a bear thesis too long when you're getting closer to that point where an economic actor like the government or like a central bank is going to come in and do something about it.
Yeah. The way I've always explained this to people is that bears sound smart and bulls get rich. And I think that's an important thing to remember at this time in the market. Yeah, there's been a lot of examples of things where the government has stepped in to like you said, dampen volatility, restore investor confidence. So I think the other thing too is that, just like you said, not get too complacent. If you're convinced everything is bearish, there's a risk that comes from sitting on the sidelines and not participating in the market too, and that's something to factor in as well. So having some dry powder can make sense, but you don't want to talk yourself out of everything so you miss the entire market. You know?
Yeah, and look, I think the other thing to be reminded of is the action that the central bank of the government will take to arrest those declines in risk is more liquidity, right? And so it's debasement of the currency, it's money printing, it's something that's going to inject liquidity. And so for for the crypto audience here, that's been part of the Bitcoin bull thesis for a long period of time. It's that the government really will not allow for supply demand to get back to normal, will not allow for asset prices to correct too aggressively, and will always shy on just pumping more liquidity. The question will be, at some point when you have $37 trillion in debt and a $2 trillion a year deficit, those decisions to pump more liquidity in are obviously causing some issues now in the bond market, in the sovereign bond market, in the long end of the treasury market. And so, do we get ourselves into a position where the kick save that the administration or the Fed does, it comes in when asset prices correct, leads to an even larger backup in yields in the bond market? And then we have an even bigger crisis, which probably then necessitates QE, yield curve control. At that point, the dollar hegemony is finished, right? And that is that's when you go. That's when gold and Bitcoin really start to do what I think a lot of investors and people think is likely and possible to happen. And so, are we at that point now where the next time the administration or Fed comes in to do something, it becomes explosive to inflation expectations, to inflation sensitive asset prices? And then we find ourselves in a situation here where we have a much larger inflation problem at hand.
Yeah, I think that's very helpful. I think the place we're coming up on time here. So the place I want to close on is, we said kind of earlier in the episode, like what's working will continue to work. Just how should investors be thinking about their portfolio? What are you bearish on right now? What are you bullish on? And how should investors be positioned going into the second half of this year?
Yeah, as I've been talking about, I mean, I think the rally from the Liberation Day lows has obviously been, very impressive, very aggressive. Certainly come further than I thought it would. But we're now at a point now where much of the systematic flows are back in the market. Vol control funds are heavily exposed. CTAs are heavily exposed. Passive flows are heavily exposed again. And we have compressed volatility here to levels which I think are unsustainably low, right in the period of time where seasonally volatility likes to find a bottom and move higher again. And we're coming into a fairly risky type period here for the Fed with respect to easing, for the economy. Is it slowing at a more rapid pace than not? Is the labor market deteriorating? And with respect to inflation, continuing to grind higher and move higher. The PPI this past month for July was about as high as we've seen in years. So a pretty uncertain period here for monetary policy. Tricks coming from the administration are probably not there right now. We already passed the one big beautiful bill. There's really not most of the tariff deals are already done. So we're not really likely to get a kick save there. So with volatility likely to move higher here, I've de-risked a lot of my portfolio, and our investors and clients' portfolios have been raising cash over the course of the last few weeks here. And I think, what's likely to happen here is a period of chop to downward bias here over the course of the next few weeks and maybe months as the markets digest some of these aggressive gains that we've had. And then, look, from there, we'll have to determine whether or not the Fed gets more aggressive in cutting rates. Does the administration do something with respect to next year's budget that helps support the economy? And do we have that seasonal year-end rally on back of something like that? So from now, it's chop, but broadly, I still think this idea that the administration will print money, will find ways to help support asset prices is going to be in there. And so opportunities to, buy Bitcoin on dips is still something that, I'm largely in favor of. And I think we will get an opportunity here in the coming weeks to really get something on that front. So right now, head on a swivel, be cautious, seasonally weak period, liquidity is drying up. People come back to work after Labor Day, and everyone's got to try to figure things out pretty quickly. Expect that chop and use that volatility as a period of time to maybe redeploy some of the cash that has been taken off, for that year-end move.
Thanks so much, Craig. Where can we send people to find more of you and your work online?
Perfect. Yeah, I'm heavily on X there. My handle's there, CES921, and then you could visit us at thebeartrapsreport.com to see some of our products, and I write some stuff on Substack as well. But again, John, thanks for having me. Really appreciate the time. Pleasure talking to you.
Yeah, absolutely. Thanks for being here, Craig. Really appreciate it. Thanks for being on Milk Road Macro. Thank you all for listening. And just a quick reminder, everyone, nothing we said in this episode was financial advice. The information shared today is just for educational and entertainment purposes only. It is not financial, legal, or tax advice. The views and opinions expressed here are our own and do not represent professional advice. We are not financial advisors, so please chat with a qualified professional before making any investment decisions, especially when it comes to crypto, as it carries significant risks, including the potential for losses. Thanks to everybody for being here. Thanks for joining us on Milk Road Macro. Stay bullish, stay educated, keep your head on a swivel, as Craig said, and we will see you all on the next episode of Milk Road Macro. Thanks.
As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening, and my friends, have a wicked awesome day.